So we're right at 3,800 on this Tuesday morning. Obviously, a lot of news to come today. Let's get to Bob Pisani. Morning, Bob.
Good morning, guys. Happy Tuesday. And you're right, 3,800. And no follow-through to the modest sell-off that we got yesterday. This has been characteristic the last couple of months. You get one down day and nothing next day. There's no real trend on the downside. Take a look at the sectors. And today is looking a lot like the way the year so far has been shaping up, with cyclical groups like energy stocks, bank stocks leading, consumer discretionary, your classic cyclicals. Tech are flattish. The exception this year, as Jim's pointed out, are semiconductor stocks. They've been performing really well. The rest of tech has been slightly underperforming the overall market, and defensive names like consumer staples and healthcare generally are underperforming. This has been the trend for a while. As for the market, it really depends on the vaccine rollout. Not so great in the beginning of the year. It looks like it's getting a little bit better in terms of what's moving the markets here. Think of the buckets: vaccines and stimulus versus virus and taxes. That'll be a bit down the road, taxes, but that's on the horizon. And of course, for vaccines versus virus, that's determining the pace of the recovery. Those vaccine rollouts starting to look a little bit better after very slow rollout. Other issues: valuations. S&P 500 is more than 16% above its 200-day moving average. That's really stretched. Normally, the S&P is about 8 or 9% above its 200-day moving average if it's bullish. This is really bullish. And the yield curve we've been talking for the bank stocks, but could be an issue down the road here. In terms of the leadership, it's been shifting. We've been noting this for the last several days now. Energy, banks, and materials have become the leadership groups now. Technology is generally flat, except for semis, which have been outperforming, and consumer staples and utilities have been the lagging groups. It's really banks that you want to be looking at. As a group, banks are up 30% since the election. That is far outperformed. What's the S&P up, 11 or 12%? So remember, banks underperformed all last year, and they are now playing catch-up. Look at these moves up in the big money center banks like Citigroup, up 50%, and JPMorgan up 34%. Even the super regional banks are all up about 30%, like Bank of America and PNC. Those are big moves. And this yield curve higher is benefiting other groups that you might not think of necessarily, like the online brokers. Charles Schwab has a very significant banking operation. Schwab has moved up aggressively in the last few days. That is a historic high for Charles Schwab that we're sitting at right now. Bank of America, in fact, upgraded them today precisely because of the banking operations here being positively impacted by the yield curve. So remember, banks up about 30%. And of course, the issue, Carl, for us now as we go into earnings season is banks are a leadership group going into earnings season. And they're, of course, traditionally start. JPMorgan will start on Friday. Carl, we haven't seen this in a long, long time. The banks are a leadership group going into earnings season. Normally, for recent memory, they've been lagging. We'll see what goes on. And remember, a lot of these banks, even with the moves up, they're still relatively cheap. It's a perfect setup going into Friday's start of earnings season.
Shepard Smith here. Thanks for watching CNBC on YouTube.